Hi guys, now I've just put together a 3-part video series on fundamental analysis. Now in this series of videos I'll be discussing what is fundamental analysis, how to profit from the news and how to read the economic calendar. Don't forget to subscribe to the channel if you haven't already done so. Don't forget to follow us on Instagram and Twitter, and of course if you follow us on Facebook you can tune in live every Monday afternoon 2 p.m. London time for a live event where we discuss market opportunities for the week ahead. I hope you enjoy this video series. Here's the first video. Okay, today we're going to talk about how to trade the fundamental news, the best ways to profit from the news. Now, the first thing that we have to ask ourselves is, why does fundamental news create money-making opportunities? Well, simple answer is because it makes the market move. It creates volatility. And of course, where there's volatility, there lies opportunities. Clearly, if the markets weren't doing anything, they're just static, then you wouldn't be able to make money by buying and selling because the price would just stay the same. So why do markets move? As you've seen from the previous lessons on the economic calendar, analysts are employed by banks and companies around the world, and they're paid to analyse and predict what they think the data release is going to be. And the consensus of all those analysts' views are published on these calendars. Now, the assumption is, when trading, that the current market price reflects the mass consensus of all these analysts. But when the actual read comes out, when it's released, if there's a large deviation from the forecast, then there is a revaluation of the value, and consequently prices move to that new valuation. So, for example, if we were expected to see, say, the US non-farm payroll at, say, 100,000, and in one particular month, say it came in at, say, 300,000. Now this would cause a significant increase in volatility. What should happen? Well, a huge number of people now employed in the workforce basically means more people have money in their pockets, and they've got money in their pockets and more money to spend. You're getting to learn this. The prices go up, that's inflation. It's basically supply and demand, and if prices go up, then the central bank may have to react and raise interest rates to curb that spending, and of course to encourage savings. So interest rates will go up, and therefore the currency should follow. Now, this is the crucial point about fundamental news. Markets don't always behave as they should. More on that in a moment. So what I've done here is I put together this little exercise for you. So if you can follow me along here, and maybe you might want to pause the screen as we go and maybe answer before I actually reveal the answer. See if you're grasping what this fundamental news should actually do to a currency. So what I've done here, I'm basically going to list a few different data releases. I'm going to show you the forecast, then we'll talk about the actual outcome, what actually came out, and then you tell me in your own words, or write it down somewhere, what you think the impact will be on the particular currency that we're talking about. So let's have a look here. Non-farm payroll. Now clearly this is a US data release. It's the US job numbers. I've just given you a bit of a clue on this one in the previous couple of sentences. But basically this is the US employment. Same number or same theory will apply, I should say, to any employment number in any particular economy. So let's say now the non-farm payroll, they're coming in at plus 175,000. 175,000 more people employed in the workforce. And let's say now the read comes in at, say, up 350,000. Markets are going to go hectic, they're going to start moving, there's going to be lots of volatility. What do you think should happen to the US dollar on this type of read? Think about it. Basically, the dollar should rise. Why should it rise? As I've just alluded to, more people are employed, more people are spending, supply and demand, pushing up prices, inflation, interest rates. Currencies normally go where interest rates go. Now let's have a look at, say, the average earnings. Let's say average earnings, the forecast is coming in at up 0.3%. M/M is month on month. Sometimes you'll see year on year. This is month on month. And let's assume now the average earnings comes in at up 0.5%. What do you think the impact will be on the currency market? Well, basically people are earning more money than the markets were expecting to see, what was already priced in to the currency before the release. But now they're coming in saying that average earnings are increasing. People have got more money, they're spending more money. Spending more money, up go prices. the currency should also go stronger on the back of that news. Should go stronger. Retail sales, let's say we're going for up 1.2%. And the number comes in up 0.8%. So the number's coming in less than the market was expecting, less than the analysts were forecasting. They were going for an increase of 1.2%. It fell short, came in at just 0.8%. Currency maybe will react to the downside because prices are not likely to increase if sales are decreasing. And if prices are not likely to increase, it's unlikely that the central bank will have to move interest rates higher. So if interest rates are not going to move higher, you may see the currency drop lower. So the currency will have a negative impact, should have a negative impact. You're getting to understand what I'm saying here about should, because it doesn't always happen as it should. Consumer Price Index up 0.5%. That's the forecast. And we come in at down 0.6%. Well, that's clearly a negative read. The market is actually not showing CPI, which is inflation, rising by 0.5%. There's actually a drop of 0.6%. That's negative, isn't it? Unlikely to see a central bank raising interest rates when the consumer inflation prices are dropping. So that's going to have a negative impact on the currency. I think you're getting the hang of this. Durable goods, up 0.5. Remember, durable goods, that's your white goods. That's the goods that you're not buying each and every month. You're putting these off. These are the big ticket items, your washing machines, your tumble dryers, your air conditioning units and so forth. Durable goods, they're going for now down 0.5%. Markets release the data, down 0.2%. What do you think about that one? A bit more confusing, this one. Well, basically, the markets were expecting a drop of 0.5%, but the drop was less than actually was expected, which is a positive news, because the sales are not as bad as they thought. That is going to have a positive effect on the currency. Should have. And manufacturing PMI. PMI, you may recall, stands for the Purchasing Managers Index. That basically is a survey to those business leaders. Are they optimistic about the economy? Are they employing more staff, investing in plant? Anything above 50 is deemed to be an economy that's expanding. Anything below 50 is an economy that is contracting. So the market analysts are going for manufacturing PMI 60.5%. And the read comes in 58.5, a miss. The markets are not as optimistic as the analysts were thinking about. How is that going to affect the currency, do you think? Write it down. Bet you got that one right. Pretty simple. The markets are going to see basically a negative impact on that currency. And finally, Producer Price Index. You've definitely got the hang of it now. By now, I can tell. Down 1.3%. Producer prices, remember what that is? That's basically what the producers have to pay for their raw materials before they manufacture their products, which clearly has an inflationary impact. If their prices are going up, they've got to put those prices onto the consumer. So it's a price index. Going down 1.3, we come in at down 0.5. Think about this one. Good or bad for the currency? What do you think? Well, the market was going for down 1.3. It actually came in only down 1.5. It's actually dropped less than the market was expecting. Is that good or bad for the currency? Sure, you got that right. It's good for the currency because the drop in prices was less than was expected. Last one here. GDP up 1.6%. You see that here? Y/Y. That's year on year as opposed to month on month. Markets were expecting an increase of 1.6 year on year. GDP, gross domestic product. Remember, that's basically the health of the economy. Is the economy growing or is the economy contracting? GDP tells you that. The actual forecast, the actual came in at up 1%. Is that good or bad? Well, it's not growing as much as the analysts were thinking about. That could have a negative impact on the currency as the economy is not growing as much as the analysts were expecting. So that's basically how markets should react. We're now going to talk a little bit about how we can profit from these economic news releases. Now, when a news release is announced, generally speaking, the market will have an instant reaction, normally in the way that I've just explained on the previous slide. Hopefully you got a few of those right. The initial reaction normally is that way. But more often than not, there's many other factors in play. You have to think about what the traders were doing in the run-up to the news release. Were traders getting themselves long? Were they buying ahead of expecting a more positive release than the analysts were predicting? Or were they expecting more of a negative release than what the analysts were putting out there? So there's positioning ahead of the news release. So we don't know for sure that the market will react indeed in that particular direction. Now, sure thing, if you have the fastest fingers first there and you're competing with these big institutions that have internet connection speeds at nano of a second, and you're there sitting on your home Wi-Fi, chances are you have a bit of a disadvantage in terms of getting the fastest fingers first there. The best way to trade this, I think, is wait. Buy the rumour, sell the fact. It's a common way that I like to trade the fundamental news. I let all that noise, all that fast pressure, instant reaction for the other traders. So this is what I tend to like to do. I look to see if the impact news is low or medium. Now, if the impact news is low or medium, that basically means it shouldn't have too much effect on prices. So I let the noise die down. So I wait for the news release, I wait 5 minutes, and normally, in my experience, the chances are, or the higher probability, is that the price will move back down to pre-release levels about 5 minutes after the news release. As all the noise calms down, markets go back to business, unless of course the news is vastly different from where the market was expecting and the analysts were expecting. Doesn't often happen these days, and if analysts are doing their job properly, shouldn't happen at all, really, should it? But there you go, that's a different story. So on low to medium impact news, wait 5 minutes and watch the market retrace back to pre-release levels. Of course, you have your stop in place. Good place to maybe place your stop would be above the high of the impact news, or above or below the low of the impact news, high and low. Now, if the impact news is high impact news, that basically means we're expecting big moves. There's a lot more money flowing into high impact news than a low impact news. So I tend to like to wait about 15 minutes again. And again, depending on how away or how much of a deviation from the actual release to the analyst's views, it depends on how much the market moves, but normally waiting about 15 minutes for the market then to start retracing back to carry on the trend that was happening before the news release. So basically wait 15 minutes and then look at the direction of the market before the actual release. It's a good way to get the probability on your favour. Fastest fingers first, I think we are struggling with, and I certainly don't want to get too involved in that. But again, it does depend on how much out the analysts were. So this is how I like to trade the fundamental news. Always like to have my technical levels on the charts as well. Key levels of support, key levels of resistance. Often you'll see at this news release, certainly on the high impact news, you will see a level of resistance where a lot of traders out there will have their positions, have their sell orders, and the support levels. You'll see a lot of buyers have their support levels there as well. So watch to see the big impact move from those levels up to resistance, down to support, and maybe use that also as a potential selling point or indeed buying point. Having those support and resistance line levels in on impact news is a very good and valued high probability method of trading the news. So for me, I prefer to trade the fundamental news with the technicals as well. I hope you find that useful. Okay, so I hope you enjoyed that video. Give me a thumbs up if you did. Give me a thumbs down if you didn't. Don't forget to leave a comment as well. I read them all and get back to it as many as I can. Don't forget to follow us, of course, on Instagram and Twitter. If you follow us on Facebook, I'll see you there 2 p.m. London time for the live event. Now, don't forget to subscribe to this channel. That way you'll be notified the moment part 2 of this video series is released. Have a good week.